Right. Hello, active duty passive income. This is Adam Labar over here, trying to drop into a short video, show you some of the differences between single family or residential houses and the multifamily or commercial properties that I tend to be leaning towards. I know I've mentioned a couple times that I'm going to try to show some differences and do some different videos or blogs for you guys. So this is going to be the first of hopefully many. First thing I want to discuss is some of the differences between the two. So first off, your residential. If you haven't seen some of our videos or some of the training that we do, if you haven't seen some of that stuff, so your residential is going to be anywhere from 1 to 4 units. You can get a residential loan for that. Your typical one that you may or may not have used for your personal property, or your normal 30-year amortization, the normal bank loan that you would go and get. That is your 1 to 4 unit property. The multifamily or commercial properties is 5 units and above. That's where you get the commercial loans, which have a different rate involved. They have a different amortization table because you may get amortized over 20 years instead of 30 years, but yet have a balloon payment at 10, et cetera, et cetera. There's a whole lot that's involved inside of those loans. Plus, you know, if you're over $1 million, you tend to qualify for institutional loans like Fannie Mae or Freddie Mac, that type of stuff. So really, there's a whole lot of differences going on, but I don't want to go too much into detail on all that. Basically, just understand the difference between the two is residential is 4 units and below, and commercial is 5 units and above. You get some different loans and different ways of looking at things. So part of the different ways of looking at things is the value of the property. And that's today, one of the things I want to talk to you about is the value, the income, and all that type of stuff with the properties that we're looking at. So what I want to do right now is look over some regular houses on realtor.com over in Kansas City, Missouri. If I want to go buy a property right now, I'm going to go to realtor.com and hit enter in that area. Obviously, I can break it down however I want to do it, how many beds and baths I want. But what I'm looking at right now, $200,000 house, 2 bedrooms, 3 bath, right? And we've got a 4 bedroom, 3 bath here for $245. We've got a 3 bedroom, 3 plus bath, 2,300 square feet for $330. All right. So how do people get these prices? Where do these prices come from? Right. If you've seen some of the videos, you may have an idea. If not, I'll just go over quickly how it's done. And I'm hopefully not talking down to you guys, but in general, if I'm looking to buy this property, all right, this price that I'm looking at is going to be based off of what this property over here sold for, or the one across the street sold for, if they're in the general arena of what I have here: 2 bedroom, 3 bath, 2 car garage, et cetera, et cetera. So if that's what I'm looking for, then I have to look at the comps or comparable sales in that area, all historical data, right? So if I look at the historical data of the houses sold in that area, that's going to give me an idea of what the price of the house I'm looking at buying. So if this house over here sold for 180, but this house they're trying to sell for 200, that's an issue, right? We're not going to buy this house for 200 because that one just sold for 180 and they're almost the same thing. So unless that house is falling apart inside and needing a lot more work than this one, then it's not actually a comparable. That changes it up, right? I don't want to pay 200,000. The same thing, like if I live in this house and my neighbor's house sells for 180 and I've been trying to sell mine for 200, that makes me sad, right? If I'm an investor and I'm trying to sell my house for 200 and this guy just sold his for 180, that makes me sad. All right, because I want to sell mine for 200 because I know that's what it's actually worth. This guy just may have been in a pinch, but it doesn't matter if he was in a pinch. He sold it for 180. So now that's one of the comparables that somebody's going to look at when they go to look at my property that I'm trying to sell. So that's just one of the small downfalls. It doesn't, it's not a deal killer or anything like that, but it's just something that I look at and something that you should be thinking about as well on all of your investment properties. Now, a commercial property is a bit different. I'm going to come over here to loopnet.com. I've already got some searches up and running in the Knoxville, Tennessee area. It's one of the places that I'm looking at buying an apartment building at. So if you look here, we've got the 8-unit property for $415,000, a 16-unit property for $550,000, a 4-unit property for $325,000, et cetera, et cetera. So how are these prices calculated? How does somebody decide what they are going to sell their property at? There's a big difference between a 16-unit property and an 8-unit property. I mean, that's twice the amount, plus there's a lot more than twice the amount of square footage. So, I mean, if you look at it that way, I mean, that should be a bigger difference if you look at it the way that goes, right? But it's not, right? We don't look at comparables for that. And obviously these aren't right next to each other. They're across the river. One of them's near the school, one of them's not, et cetera, et cetera. So um, it is a bit of a big difference. So how does that price come in? Where do we get that price, right? So one of the ways we look at that is the general market cap rate, right? So what is a cap rate, right? That's a capitalization rate, as the full name is. Usually you're going to hear it as a cap rate. So the capitalization rate shows basically the potential that a real estate investment will give you in return, right? So the higher the capitalization rate as an investor, the better, right? If I'm buying a property, I want to buy it at a higher capitalization rate. And if I'm selling a property, I want to sell it at a lower capitalization rate, just because you'll see the different calculations and why that's important here in a minute. But that is how a property is looked at. I'm going to slide over here. You're going to look at the net operating income, the cap rate, and the value or the price. The ERV calculator. So if you guys remember the density equals mass times volume and the DMV thing you guys set up, this is basically the same thing. Income equals rate times value. And income divided by rate equals value. So that whole triangle that we have seen before, if you remember back to junior high. So if I'm going to do a quick example here to try to make this a little easier to understand. Let's say I have a 10-unit property and it's $1 million. One more zero in there. Let me actually put commas because it's going to be easier for me to realize what I'm doing. All right, so 10 units, $1 million for sale. So if the general cap rate in an area is, let's say, 7% cap rate, so then if I want to look at what can I estimate my net operating income is going to be, then I look at it this way, right? I've got the value right here and the rate, 7%. So what should I expect that income to be? I'm going to do the value times 0.07 for the rate. So I should expect that I'm going to get $70,000 of net operating income. All right. So what is my net operating income? Your net operating income, or NOI, equals your income minus expenses. Okay. So it's kind of basic, right? So if my expenses are 100, or if my income is $140,000 and my expenses are $70,000, then that will make my NOI $70,000. So, and that's actually a general rule of thumb, is 50% of your income will go to expenses. It's a general rule of thumb. Obviously, you need to actually underwrite your deal, actually run the numbers properly to make sure that you're looking at everything correctly. But as general rule of thumb, 50% of your income is going to be expenses. So let's say I want to sell, or I want to increase the value, or I want to sell my property. Let's just start with selling my property. If I bought it for $1 million, and right now I get $1,200 per month in rent. All right, so if I get $1,200 per month in rent, times 10 equals, it's gonna be $12,000 a month, times 12 months equals $144,000. So $144,000 a year in income. And then remember I said about half of that is going to be expenses. I'm going to divide that by 2, and that's going to be about $72,000. So equaled 144,000 divided by 2 equals 72,000. So if I have $72,000 net operating income. So if I have my net operating income, I bought my property for $1 million. My net operating income is now 72,000, and I'm going to divide that by the capitalization rate, the 7% capitalization rate that the area has right now. So divide that by 0.07 equals, now my property is worth $1,028,571. So that is how I get what I am what my property is worth. It does not matter what my neighbor's property is worth. It doesn't matter what the guy across the street or the guy down the road, it doesn't matter what any of that is. They may affect the capitalization rate as a whole, but what really matters for me is my net operating income. So if I want to increase the value of my single family house, I can, if the neighborhood will allow it, if the market allows it, I can put a bunch of granite countertops in, or I can adjust a bunch of the, I mean, I can put a pool in the backyard, which is 9 times out of 10 not going to increase it to the point where you just spent. But I could do all these things to hopefully increase the value of my house. But if I have a $500,000 house next door to me, and I bought my house for $500,000, and I put a bunch of money into it, and I put $100,000 into it, doesn't mean I'm going to sell it for $600,000. It's still a $500,000 house next door to me, and a $510,000 house on the other side. So I'm not going to get all the way up to $600,000. It's unlikely, right? If we all are close to the same. But if I increase the value, if I increase the net operating income of my apartment, it does not matter what my neighbor sold his apartment building for. It doesn't matter what the house across the street is being sold for, because the bank looks at this as a business. So take a look at the apartment and think of it as a business. So if I can increase my bottom line, my net operating income, then I'm going to increase my value. If I decrease my net operating income, I'm going to decrease my value, or the price that somebody will pay for it. So if let's say the rate stays the same, we're going to make the capitalization rate the same. Only let's lose. No, we increased it from 1,200 to 1,250, right? Not a huge increase, right? $50 a month, but the increase that it's going to have on the value you're going to see is rather immense. So 1,250 times 10. Right, so now we have $12,500 a month times 12 equals, so I get $150,000 a year. And I'm going to divide that by 2 again, because my expenses are going to stay about the same, like 50%. So now I've got $75,000 instead of $72,000. So we've got that $75,000 in income. We're going to divide that by the cap rate, 0.7 equals. All right, so now our property is worth 171,428. So I just increased the property value by $43,000, right? So if I've got 1,071,428 minus 1,028,571 equals almost $43,000. I increased my value of my property by just raising the rent $50 a month. Raise the rent, and it doesn't have to be the rent that gets raised $50 a month. I could decrease the expenses by $50 a month. If I could find a way to do RUBS, or ratio utility billing system, set that up where if I'm the owner and I'm paying all of the expenses right now, I could set up RUBS if your market allows that. Not all markets A, legally allow it, or B, accept that, because if none of the other properties are doing RUBS, you're probably not going to get away with doing RUBS. But if your area allows for RUBS and looks at it that way, then you can bill back based off of occupancy, based off of, there's various different ways to do it. There's companies that'll do it. You just have to keep it below the actual cost of okay, I'm going to go too far into a depth that I don't need to go into. Now we can talk about RUBS at nauseum later. But if I decrease my expenses by now putting some of those expenses on other people, so if I kept the monthly rent at $1,200, but yet I just billed them back $50 worth of the expenses for the utilities, people look at it completely differently when you're billing them back for utilities, right? And they're also probably going to use less water. They're probably going to use less electricity because they're getting charged back for it, et cetera, et cetera. So if you decrease your expenses by passing some of those on to your tenants, or just by changing to more efficient toilets and shower heads, right? That could lower your expenses if you're not able to do RUBS. And if you do that, then you will, at the same point, be able to increase the value. It doesn't have to be an increase in your monthly rent. It could be an increase or a decrease in your expenses that helps increase your value exponentially. So that $50 a month brought up the property $43,000. So if I buy that 10 unit apartment complex, I fix it up, I do what I can to it, I get it running more efficiently, I bring those expenses from 50% down to about 45%, et cetera, et cetera. 2 years later, 3 years later, I decided to sell the property. So not only was I making the money in my pocket, the passive income that we were wanting to all get, we're all trying to get. Yeah, so not only was I getting that passive income in my pocket, but I increased the value of that property by $43,000. When I go to sell it or refinance it, now that money goes back into my pocket. So that is the way a bank is going to look at it. That is the way we should be looking at a multifamily property, is with the IRV calculation right there. So again, this sounds like it can be complicated, and it feels like it can be complicated, but the more you do it, the more you understand it. So with education comes confidence. With your confidence comes your action, right? So the more education you get in any niche that you're looking at, whether it's turnkey, whether it's doing the BRRRR strategy, whether it's buying apartments, or whether it's buying mobile home parks, whatever your niche is, the more education you get in there, the more confidence you're going to have. The more confidence you have, the more action you'll be willing to take, right? So build up the education. That's our goal here, is we want to build that education, to build that confidence, to get to that action. So this is just a quick, semi-quick video to show you guys what we're looking at, to show you guys some of the differences between the single family or the residential and the commercial or multifamily side of the house. So again, my name is Adam Labar. Hopefully I was helpful. Hopefully you guys understood that. Hopefully you guys can interact with me and tell me where you thought I can improve. Tell me where you thought it was good. Ask me if you have any questions. My email is adam@activedutypassiveincome.com. Again, that's adam@activedutypassiveincome.com. I'm more than happy to help where I can. Again, my focus is mainly on the multifamily side of the house. So if you have any questions there, just shoot me an email, hit me up on the Facebook, hit me up on the Start the Spark page, wherever you can find me on there. Let me know. I'll be more than happy to discuss some of this in further detail. Again, hopefully there's going to be more of these, or there will be more of these videos in the future, so be on the lookout for them. Hopefully you enjoyed this, and it helps you understand a little bit better. It gives you a small amount of confidence or understanding between the difference of the two. All right. Thanks a lot, everybody. Have a good day.